The world's most important central bank, the U.S. Federal Reserve, is widely expected not to change the cost of borrowing when it makes its latest interest rate decision later. But more than ever, there will be a huge focus on what this man, the chair of the Federal Reserve, Jerome Powell, says about the outlook for the U.S. economy and how that differs from President Trump's opinions. The main interest rate is at a range of 2.25 to 2.5%. But on Tuesday, President Trump tweeted that we have the potential to go up like a rocket if we did some lowering of rates. He's talking about the economy there, of course. Cutting that rate could help increase inflation. At the moment, using the Fed's preferred measure called PCE, it is at 1.5%. That is below the 2% target. However, last week, the U.S. economy recorded annualized growth of 3.2% for the first part of the year, above expectations. And if that trend continues, it could lead to pressure for rate rises. Let's speak to Jay Shambaugh, who is a former economic advisor to President Obama, now with the Brookings Institution think tank in Washington. Jay, the president putting pressure on the Fed to boost the economy by cutting rates. The GDP data suggests they might have to think about taking rates in the other direction. Should they just ignore the president then?
Well, I think in general, the Federal Reserve is really insulated from politics. That's the setup, the design of the institution. So I don't know that they'll ignore the president, but I don't foresee them kind of taking any action based on what the president says.
It's interesting. He does have a point. In the eyes of some, they'd say if you keep borrowing costs low, that would then help, boost the economy. It supports the economy that is growing at a fairly decent pace.
Yeah, and I think the important thing to remember is the Federal Reserve's not looking at the stock market. They're not looking at GDP. Well, they look at them, but those aren't their targets. What they're targeting is inflation and the job market. Those are the two mandates they have to follow: maximum employment and stable prices. And so with inflation around 1.5%, as you mentioned, they're targets too. So in that sense, they definitely have room to try to push the economy a little farther. I think actually what they've done in the last few months when they've said we're not going to hike anymore is itself pretty important in terms of supporting the economy. It kind of takes the expected path of interest rates down from where maybe people thought they might hike a few more times, and instead that can help support financial markets. It can help lower long-term interest rates. So in some sense, they're already doing those things to support the economy based on the fact that inflation is in fact lower than they'd like it to be.
I suppose the point the president is making is that if, the growth in the U.S. economy is at such a decent rate now, 3.2% annualized, according to the latest figures, that, in his words, he sees the potential to break records and get it steaming ahead and going up like a rocket.
Yeah, and as I said, I think in some ways that's just not literally what the Fed is going to be targeting. They're worried about the job market, and there they want to see kind of pushing the job market as far as it is able to go sustainably, and they want to keep inflation around that 2% target, and they're a little low. I think, honestly, the big thing they need to be thinking about, or everyone needs to be thinking about, is when the economy hits a downturn, the Fed usually cuts rates around 5 percentage points over a cycle. And as you mentioned, right now they're sitting, below 2.5%. They don't have that much room to cut in the future, which means other policymakers need to be ready to think about what do we do in a case that the economy does eventually slow down. I think the last quarter point up or down right now is probably not the most important thing relative to them sending signals about the long-term path. And everyone else needs to be ready to think about what do we do in case things slow down. It's something we at the Hamilton Project, where I am, we've thought a lot about kind of ways to increase fiscal spending automatically if you do hit a downturn. Things like that, I think, are probably where people should be focusing their attention, just to make sure we can keep the economy on a stable path.
OK, Jay, really good to talk to you. Jay Shambaugh there, joining us from Washington. I'll be back with more business in a couple of hours' time, but in the meantime,